from the morning reading. We're finally seeing some initial signs of a breakdown. Every time we've seen that in the past year, buying pressure has come in, so we'll see if that continues. Optimism hasn't dropped enough yet, even though a fairly large decline, to trigger a reduction in the risk level. This is a healthy long-term trend with a series of higher highs and higher lows, but we're seeing initial signs of exhaustion with multiple days when stocks failed to follow through on new highs. Rising dollar boosts small caps. While large caps sagged this week, small caps fared better. The Russell, or RUT, ended the week on a strong note and above its 50-day moving average. We suspect the reason for this divergence is the Friday strong jobs report and a rebound in the US dollar. Since the start of the year, the rising dollar has given small caps an edge over large caps. The dollar drop during April benefited large caps. The dollar rise over the last month has benefited small caps. Large caps are more sensitive to trends in foreign markets, most of which fell this last week, especially in Europe. The Dow and S&P 500 slip while the Nasdaq holds firm. U.S. stocks lost ground during the week, but not enough to do any serious damage. Dow Industrials fallen to the lowest level in a month and sliding below the 50-day moving average and rising volume. But the Dow is yet to break rising support line drawn from the April-May lows. The Nasdaq bounced on Friday to end the week essentially flat. It remains above the 50-day moving average. Although the broader market lost ground, it's doubtful that it will fall very far as long as the Nasdaq continues to hold up. And then on the bonds, Treasury bonds yields surged to the highest level in 8 months. The surge in bond yields is obviously bad for bond prices, which fall when yields rise. I suspect the surge in bond yields is also starting to worry global stock investors, which may account for this week's selling. The biggest impact on rising yields, however, is seen in the various stock market sectors that are specifically sensitive to interest rates. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:22 a.m. Central Time, and I'm recording this in preparation for the market day of June the 8th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see just what has happened with our Sunday night into Monday morning. The 4 broad market indices are essentially scratched to just a teeny bit weak, not enough to really note anything, and obviously could change by the time the market opens. Crude oil made a bigger move, down 0.78%. Euro scratch. Bonds up 0.3%, and then gold up about 0.5%. Big movement overseas in China. China up over 2%. Hong Kong up 0.2%. Japan scratch. Germany down about 0.5%. United Kingdom essentially scratched to just barely negative. In terms of macroeconomic reports for today and tomorrow, we have really nothing of note in the United States. One little yellow flag report. We do have G7 meetings occurring. Always possible for something to roll out of that, but doesn't seem like anything really to get excited about today. Tomorrow we have JOLTS, job openings, and that would seem to be about it. So pretty quiet start of the week from the macroeconomic report standpoint. On a volatility standpoint, obviously short-term VIX 13.70. We've had a little more action in recent trading days, but it's still very low volatility, very low implied IVs, 25, 13, 28, 41. Nothing at all to get excited about on any of those things. No standard deviation moves were put in on Friday. Obviously we had more activity on Thursday of last week, but relatively quiet on Friday, and indeed the number of standard deviation moves is slightly below average in the last 2 trading weeks, so nothing really to get excited about there. In terms of our regular daily report, fairly straightforward today. Still in that phase 3 higher highs, higher lows, intermediate term phase opinion. IBD status continues to be confirmed uptrend. GMI index a 5 out of 6, so up 1 notch. We do have some mixed signals though from the market posture. It is flat out bearish, and indeed the S&P at 55 is in danger of going very bearish, so signaling no new short-term or intermediate-term bullish trades. Dow also very bearish. But then, as we had from the morning reading headlines, we had NASDAQ still doing better and Russell doing better. NASDAQ is very bullish, Russell is bullish. All this put together, along with the various other warnings from below, we have a threshold level 0 plus, normal with cautionary aspects on our hedge warning status. From a volatility-based standpoint, not much to get excited about here. We still had that VIX daily squeeze, but of course that can persist for prolonged periods of time. More concerning is the number of distribution days. We have 4 already on the S&P and NASDAQ. If that rises to 5, that could trigger an elevated risk level. From the new highs, new lows, that was also concerning on Friday. 514 new lows, so pretty significant warning there. And we have on the intermarket risk aversion indicators, 2 of the 5 are flagging as risk off. So probably the thing that gets me the most on this is market posture in the S&P and Dow, and then this 514 new lows that were put in on Friday. So 0 plus, that seems appropriate for what we're seeing across these various indicators, and we're pretty content that that's a reflective assessment of current risk profile until new information comes in. Option income strategies, VIX is inside the acceptable window. Just always got to be mindful for increasing volatility when you're in this low vol environment. Cover call strategies continue to be bullish with a 3-to-2 distribution between in the money and out of the money strikes. Obviously we still remain in the range, so you want to be relatively cautious and conservative with your approach. Put selling conditions are acceptable, though I will admit that I have reduced the number of core put positions that I have on. Certainly this is true for myself. Consider put credit spreads with defined risk, and consider scaling into positions until the market has confirmed a breakout from the trading range. I think that is a very good suggestion currently. In terms of relative rotation graph for this week, last week we saw a lot of these big tails coming down out of the good and healthy upper right quadrant and falling down into this weakening quadrant in the lower right. And this is even more pronounced now. There is only one sector, KRE regional banks, that had kind of a positive action this last week. So that is also a warning sign to us that the market is not a healthy bull. In terms of sector specific, you notice in the short to intermediate term, not a lot of green here, only financials and retail. Financials probably being primarily helped by interest rates. You saw, of course, up here these regional banks, and that was one of the ones that was doing better. Now, when you talk about financials as a sector, it's a mixed bag in terms of, some are helped and some are hurt. You have the REITs in that group, and, they're generally hurt by this increasing interest rate yields. But obviously banks are helped, and banks are of course a big part of the XLF. Also, retail continues to hold up relatively well, and after that, I guess on the other side, telecom, consumer staples, energy are perhaps the weakest. And utilities. There's another interest rate sensitive sector. that are the weakest. But also always keep in mind we've been in this range bound activity. Many of these lines are very flat, and they'll flip from being down 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 to up 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 on a good strong up day. So these are not as indicative as perhaps they are in a more trending market environment. In terms of the percent change, only energy, financials, industrials had up activity on Friday, and really only financials are holding up at this point across all the time frames back through 3 months on a rolling basis. So again, very difficult to say that this is a confident bull market. So I think that's probably enough for today. As always, if you find what you're getting here helpful, we appreciate you liking us on YouTube. Obviously, feedback and other support to support at falconglobaltraders.com. I'll get that. More information available on what we do and how we apply this into our daily trading at the website indicated here. Performance matters, and we log this very well and keep track of that. Disclaimers as always. Hit the pause button if you need more time to review this. And we'll see you back here tomorrow morning before the market open with the market preview.